Well, hi everyone. Welcome to the Buffett and Beyond Research Stock of the Week, and we're going over Pulte Homes. And is it time to buy the home building stocks after the decline? You're going to see some amazing charts here. So remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at Pulte Group. Well, it's one of the nation's largest home builders, and the company builds single-family homes and develops residential subdivisions, rows and rows of houses. It operates in 26 states and more than 45 markets nationwide. And in 2023, it sold 28,603 right in here units at an average price of $545, and 29,000 in 2022. So 29,100. So we're talking about a difference of about 500 units in here, and the average price in 2022 was $542. So $3,000 difference. But of course, in 2023, mortgage rates were starting to go up, and of course, 2024 they went up and they started coming back down again. So we'll see what happens. Maybe that's why we just read an article on the news feed that said it's time to buy some of the home building stocks because they have been oversold and they've come down a long way, which we're going to see in a moment. Now, Pulte Mortgage Group Corporation is a wholly owned subsidiary and is a national mortgage bank, so they do financing. All right, now let's look at the green bars here, which is Pulte Group, and the blue bars represent the average stock, average large cap stock out there. And we're looking at the clean surplus return on equity. Remember, that's a comparable ROE, where traditional accounting ROE is not. So the average stock is about 13.5%, and Pulte is 20.7%. So the question always is, would you rather put money in a bank that's returning you 13.5% or one in a bank that's earning about 20.7%? Now, kind of the rule of thumb when I did my research years ago, and it's still pretty true, is that if you take this ROE and multiply it by 0.8, so about 80%, that is the average return of the stock market. So when you look at this 13.5% times about 0.8, we're looking at about 10% return per year, and our portfolio has grown about 0.8 of this, or about 17% per year over the past 22 years. So we're looking at good comparable numbers, and this is a really good comparison ratio. And it's been holding true since I've been researching this, which is 22 years of actual portfolio implementation and 12 years before that. So we're looking at over 34 years or so. And when we look at the net income, which is the clean surplus earnings, in other words, you take traditional accounting earnings, subtract non-recurring items, all those little specialty events that happen, and you take away future liability or anticipated future liabilities, and you get a much cleaner income or earnings picture, and that's what net income is. So we're seeing 23% versus the average stock of about 13%. Then when it comes over to here, 18%. Now remember, this is a 5-year average, 18.6% for Pulte and 7.1% for the average stock. So this is about 2.5 times that of the average stock. So we would expect Pulte Group to outperform the S&P 500. And remember that over any 10-year rolling period, that 96% of professional money managers, and those are the folks who manage the publicly traded mutual funds, 96% of them cannot outperform the S&P 500 over a 10-year rolling period, where the clean surplus method allows us to return 2.5 times that of the S&P 500. So it's a nice strategy, folks. And let us look at a table of closer look of 1 year. Now, 2024, it had net income of $13.65, which is a little bit higher than anticipated a couple of months ago. while we were still in 2024, they expected this to be a little bit lower, but it came out a little bit higher. And for next year, this was a little higher, and they dropped it about 12 cents only, $13.80. So it's still pretty good. Looking at the clean surplus return on equity, the only thing that worries us is this ROE continues to go down, and we don't like to see stocks that have that ROE declining. Retention rate is in the 90s, 90% or so, so it's paying just a little bit out in dividends all the way over here. And when we see the retention rate in the 90% like that, we say, okay, this company is putting all the money it's making back into itself in order to grow, or most all of its money back into itself in order to grow. And net income, and here's where their outlook for next year is lower, and in fact it's really quite low, that they will not increase the earnings. They're still going to make very good earnings, but they're not going to make as much as their average, 5-year average of 23%. Then when we come over here to revenue growth, well, revenue growth for next year is going to be 8.6%, which is still ahead of the 7.1% average of the individual companies out there, large cap companies, but it's below the revenue growth rate of 5 years for this particular stock. So yeah, it's slowing down. They expect smaller growth for next year, and that's because of they're looking at the mortgage rates. But recently mortgage rates have started to come down. So let's look at 1-year returns. Black line is the S&P 500, and you can see this real big downturn we are in right now. And it had been outperforming the S&P 500, and then when mortgage rates started going back up, it declined, and now mortgage rates are starting to come back down again. And look at this. We're starting to get a bounce back as I'm recording this. Well, we're going to see it in a chart in a minute. As I'm recording this, the market is down 2% today. I'm not recording this on Thursday, just before the market closed. This stock is up 2%. So there might be something there in saying that these stocks are oversold. 5 years, yeah, it outperforms the S&P 500, just like the numbers show us. When you have an ROE, clean surplus ROE, above 13.5%, you expect outperformance by the stock. And that's exactly what we're seeing here over the 5-year period. Now let's look at a closer look, and this is 1 year, but it's the candlestick charts, and you can see that this stock has had a dramatic decline, and now it has started going up 3 days in a row. And before we close in on that, let's look at this indicator up here. It has turned up. This intermediate term indicator down here has just turned up. So we have a lower low in this particular stock, and we have a higher low in this indicator down here. And this is our intermediate term indicator. Let's zoom in a little bit so that we can see this nice rally that we're finally starting to get. And behind it, you can see the vertical green lines. Well, that is the volume on an up day, and we have had 3 up days in a row, which are very, very nice. And as I said, the market is not closed yet, so we don't have this final green line in here to the fullest. And this indicator up here, as I said, is going up. And again, while the market's making a lower low, this indicator is making a higher low. And that's what we like to see in a stock. And even though the market's falling apart around us right now, boy, oh boy, this stock is doing very, very nice. And of course, what the article was just saying, and this stock was recommended by one of the analytical groups out there. And after this long decline, yeah, we're seeing. But we have to get above this 50-day moving average or so, because you see these declining tops in here. Let's draw this line down here, and we want to see this rally take us past that line. If it does, we think we have a nice rally going on in here. So, folks, we're having a rough couple of weeks in the market, but all of a sudden the home building stocks are starting to look pretty decent here. And that's what we like to see. So what you want to do is go out this weekend, forget about this market, oh my gosh, and just take your mind off it and just enjoy the out of doors, go for a walk, even if you're up north, be with your loved ones over the weekend, and take the weekend off because the market will be open on Monday, and we'll be back with you in a couple of days, folks. Stay safe, and we'll see you soon.